The World Bank slashed its global growth projections, putting it within recession territory, though the outfit was careful to avoid using that term, given the politically sensitive mandate that they operate under. But the Swiss bond market wholeheartedly agrees with the forecast and more so the interpretation. People don't realize that Swiss rates right now are very negative and they're getting worse. And that's what we see in U.S. consumer prices. The U.S. CPI continues to defy all expectations of accelerating inflation. And instead, when you strip out the fake shelter imputation, the rest of the consumer price bucket was negative on a 3-month basis. Negative. Everything today came up negative. We got negative consumer prices, negative bond rates, negative growth downgrades, and all of them are really the same thing coming from very different angles. So the World Bank slashed its 2025 growth projections down to the same level as, get this, 2008. It's now lower than every single year of the 2010s, in the same territory as all the prior outright recessions. And worst of all, this puts the global economy on track for its worst decade in 60 years. Yes, worse than the 2010s. Where have we seen that one before? Oh yeah, the swap market. No wonder Swiss bond rates are already negative. And the worst part of those is that they've gotten more negative since April 8th, since the tariff delay announcements during these same 2 months as stocks have staged their massive re-risking comeback. And while Jay Powell keeps freaking out over tariff-driven inflation, there's no evidence of any. March through May, the CPIX shelter outright declined. That's not a good sign. It's actually the same thing as Swiss negatives and the World Bank downgrade. All of these are different perspectives on a global economy, which is struggling between a rock and a hard place, between costs that are rising and demand that is so weak and fragile it falls apart at the slightest attempt at price changes. And so what happens? Like the World Bank's projections, the 2020s end up somehow being worse than the 2010s. Exactly what I've been telling you for years. Exactly what the swap market and the bond markets have been pricing all of this time. And here we have more of these same pieces falling into place, unfortunately. What the World Bank said in its latest update for June 2025, the global growth projections and commentary, in that commentary, the World Bank said, global growth is slowing due to a substantial rise in trade barriers and the pervasive effects of an uncertain global policy environment. They always throw uncertainty in here because the trade wars and the barriers themselves don't really explain the downturn in the global economy. It's not really uncertainty. As I keep saying, it's becoming more and more certain. It's the fragile economy. But back to the World Bank. Growth is expected to weaken now to 2.3% in 2025, with deceleration in most economies relative to last year. In fact, they marked down, I believe, 70% of all economic projections. This would mark the slowest rate of global growth since 2008, aside from outright global recessions in 2009 as well as 2020. Basically, the World Bank is describing the forgot how to grow economy and how we got to this point without, of course, using that term. And 2.3% makes it sound a lot better than it is. 2.3% for any calendar year for the entire world is firmly within recession territory, at least within recession risk territory. It's the same as the U.S. economy. The U.S. economy individually, whenever any calendar year GDP growth rate gets down to around 1.5%, 1.3%, it's almost guaranteed to have a recession in that calendar year. That's what the World Bank is saying, especially when you look back at their global growth estimations going back to the 1960s. Now, before we get back to the rest of today's video, I want to tell you about today's video sponsor. We talk all the time on this channel about the dangers the world is facing, trying to come to grips with the aftermath of the pandemic and the lockdowns, the difficulties associated with the supply shock and price illusion, not to mention still living in the shadow of the 2008 crisis. To put it mildly, there's a lot of systemic uncertainty. Now, I've recommended gold as a store value hedge for years. In fact, it's the ultimate error hedge. While gold prices are at an all-time high, price appreciation isn't the only way to profit. You can earn a yield on gold paid in gold without selling your metal. When the price of gold increases, so does the cost to store it and insure it. Don't lose money owning gold, earn a yield on it instead. And Monetary Metals allows you to earn up to 4% on your metal in their gold leasing program. And you start earning that 4% yield immediately upon funding your account. The yield you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation from gold and silver during the year. So join the thousands of investors earning interest in physical gold and silver every month with Monetary Metals. There's a link in the description of this video that has all the information that you need. We thank Monetary Metals for their sponsorship. And now back to the rest of this video. Now what the World Bank did was they downgraded their projections ever since the last update back in January. For world GDP overall, like I said, they're down to 2.3%, which was 2.7% back in January, at least for the calendar year 2025. For 2026, the projections are now 2.4% when they were 2.7% back in January. And a downgrade of 0.3, 0.4, 0.5, as we'll see here in just a second, those are much more severe than it sounds as well, because these outfits, these model projections, they don't move all that quickly. They're always over optimistic and they have to come down, and they don't usually come down in big chunks like this. For the United States specifically, the World Bank downgraded GDP for 2025 to 1.4%. So there it is, right in the recession territory, right in the recession risk range. And that's down 0.9% from their January estimate. So they see the fragility growing around the rest of the world, including the U.S. economy. And of course, they're blaming trade wars and trade barriers when it's really the forgot how to grow economy that's getting into more serious territory. For advanced economies overall, they're now thinking just 1.2% for 2025, down 0.5% from their January projection, and just 1.4% for 2026. So not only are they forecasting recession-like territory, recession-like conditions here in 2025, they're saying the same thing for 2026, which means they're not really certain there's going to be any immediate and as well as substantial recovery from here. So it's not just 1 year or two, and that raises the chances of a global recession happening, especially when, again, you go back through their history. And what you see is that throughout their long history, going back to the 1960s, global growth that gets into this range, there's a recession lurking in there somewhere. For example, 1974, global growth in the year 1974 was 1.9%. There was a global recession that year. 1980-81, the first part of the double dip, those were both 1.9% each. 1991 to 1993, what everybody blamed on Saddam Hussein and the invasion of Kuwait, wasn't really, it was the S&L crisis that sapped global growth and then spread around the world from there. In 1991, global GDP increased only 1.2%, and it was only 2% flat in 1992, just ask George H.W. Bush. And so you have a 2-year period that was consistent with recession, right around 2% global growth. 2001, the dot-com recession. Global GDP, according to the World Bank calculation, right at 2%. In 2002, the year after, 2.3%, the beginning of the jobless recovery and Ross Perot's giant sucking sound in the United States, but also the rest of the world, especially in Europe and Asia and Japan. The dot-com recession and its aftermath was a hit to global growth in both of those years. And then 2008, as they mentioned before, 2008 was the first year of the Great Not Recession, 2.1% in 2008 before it turned negative in 2009, but 2.1% in 2008, not far off from where we're seeing 2.3% in these latest estimates for 2025. 2025 getting into the same territory as 2008. And during the entire decade of the 2010s, the silent depression, the lowest in any year for global GDP, according to the World Bank, was 2.7% in 2019, heading into what would have been a pre-COVID recession, as well as 2012, when a whole lot of the world was in recession, starting with Europe. So 2.3% in 2025 would be well below anything in the 2010s. That shows you how bad things have gotten to be. And with 2023 and 2024 both estimated at 2.8%, a downshift to 2.3% in 2025, and then maybe the same or worse in 2026, the World Bank is already recognizing how the 2020s somehow are shaping up worse than the 2010s had been. Which is exactly what I've been saying, because that's what the markets have been pricing this entire time. You think about the swap market, swap spreads. What are swap spreads? Swap spreads are the market saying that interest rates are going to go down, they're going to go down by a lot, and they're going to stay there. So the interest rate environment in the 2020s, according to the swap market and a whole bunch more, what they're saying for the macroeconomic environment is that it looks to be, at best, similar to the 2010s. And here's the World Bank coming along with its forecast and its estimate saying, we see the same thing picking up now too. We see global economic growth that's falling off when it should be speeding up. And instead it puts us, for the World Bank's numbers, it puts the 2020s on track to be worse than the 2010s, which is another interpretation of the swap market. Rates that go down and stay there, low growth, low inflation expectations, and here's the World Bank saying, yeah, we see it too. In fact, what they actually wrote was by 2027, global GDP growth is expected to average just 2.5% in the 2020s, the slowest pace of any decade since the 1960s, and sort of round-tripping the Eurodollar era. The Eurodollar shows up in the 1950s. Global growth starts to take off in the 60s and 70s. Got a little bit too much with the inflation in the 70s. But the 80s, 90s, and 2000s up until 2007 and 2008, one of the best periods of global expansion in all of human history. And now, since 2007, the 2010s were not good. And the 2020s, as the markets have been pricing, shaping up to be at least the 2010s. We hope the 2010s, if not, as the World Bank is saying, potentially worse. So this whole economic question, it's not about recession. It's not really about chances for contraction in a couple quarters here or there. It's about growth prospects, or in this case, non-existent prospects. Everyone focuses on recession because they're led to believe if there isn't one, they can say everything must be fine. If there isn't a recession that looks like the recession everybody has in their mind that's been put there by economics, then the economy must be just fine. That's the J. Powell shtick to a T. But this is not true by any means. The lack of any mainstream recognizable, officially declared by the NBR recession case doesn't mean the economy is doing well, or even that there isn't actually a recession, because you can characterize the forgot how to grow period as one, and it's only being forecast and predicted and picked up to be worse moving forward. And that's right where we are with negative Swiss yields. Yes, negative yields in bonds in Switzerland that showed up several months ago, and they've only been getting more and more negative, with more and more of the Swiss curve becoming negative. But here's the thing, something I keep pointing out too in the macroeconomic data as well as market data. Here's another clean example. You can literally see the 2023 bank crisis on the chart of Swiss bond yields. Without knowing anything about Swiss bonds, you can clearly pick out the point where something big and obvious clearly changes. It's clear as day. So policymakers back then in 2023 say they fixed everything with the banking crisis, but the markets and the economy completely disagree. The bank crisis, if you remember, wasn't just Silicon Valley Bank or even just U.S. regional banks. That's what we were told, and that's what everybody led you to believe. But Credit Suisse was a big part of it, and to this day, no one has properly accounted for that. But the Swiss bond market did, as well as German bond markets and other markets around the world. So notice how the Swiss bond curve inverts in the aftermath of Credit Suisse. By late May of 2023, even before the swap market, U.S. dollar swap spreads started to compress. And in the Swiss bond curve, this is the thing, it almost never inverts. Very rare deflationary signal from the immediate aftermath of the banking crisis. There's so much evidence that says the aftermath of the banking crisis started or at least finished off this maybe inevitable path toward the 2020s deflationary outcomes. More recently, Swiss bond yields, they've been falling since the end of November 2023, especially at the short end, but there's a big and noticeable drop in June of 2024. Last summer, summertime being the time for recession, that was certainly the case in the Swiss bond market. So as the global economy headed into its downturn in 2024, they forgot how to grow, forgetting even more how to grow. Swiss bond yields continued to go lower and lower and lower. And what hardly anyone knows, the Swiss 2-year, right at the front of the curve, they had already turned negative at the end of December, in the early part of January. Now from there, you can claim that the market had an inflation reaction January to around mid-March, where rates climbed in Switzerland and other places, and they continued to retrace. So if the market was ever thinking that tariffs were inflationary, that was the one and only time, and it didn't get to be all that much and all that far to begin with. But ever since March 12th, Swiss rates are falling all over again. And the 2-year fell below zero again the second time, right on April 7th, during the worst part of the deflationary outbreak in the global financial chaos of early April. But here's another big thing. While the 2-year would pop in and out of negative yields over the next couple days after April 7th, by April 11, they would mostly stay negative. And worse, the worst part of all this more of the curve continued to go negative since early April as well. And that was after the 90-day tariff delay was announced, the same time as stocks were soaring and the world was re-risking. In fact, the last positive yield for the twos in Switzerland came on April 24th. And then the first negative for the 5-year maturity shows up on May 7th, with both of them becoming more negative and more of the Swiss curve becoming negative over the weeks since then. Right now, the 2 years about 20 basis points negative, while the 5 years roughly -6, -7 basis points. What you have to realize is that these negative yields in Switzerland are not really about Switzerland. The Swiss bond market, like the Swiss franc, is more focused on things that are going on outside of Switzerland because of Switzerland being a huge monetary node in the Eurodollar network. The Swiss bond yields are very synchronized with other rates. In fact, you can go back to 2007 and 2008. The Swiss yield curve was actually steepening, with front-end rates dropping much lower than long-end rates during the entire crisis. Keep that in mind as we go forward here. So the Swiss curve was steepening throughout 2008 and into 2009, and it never actually inverted at that time. What that says is the market in Switzerland was more focused on what was going on outside of Switzerland than what might have been the consequences inside. And then throughout the 2010s, the Swiss rates were corresponded and synchronized with all these other markets around the world, from US treasuries to Germans to Canadians to Japanese rates. So even if you believe, and you shouldn't, but even if you believe that bonds in Switzerland, like anywhere else, are just pricing what the SNB will do, it doesn't actually change anything. The Swiss National Bank has been lowering rates for the last year and a quarter to counteract, first of all, lower consumer price rates and a stronger franc. The price rates in Switzerland are decelerating. In fact, they're now negative, more negatives there, because the world is becoming more and more deflationary, and we see it best and earliest in Switzerland. And why is the franc still so strong? That's flight to safety, another deflationary signal. The Swiss franc remains, even today, closer to its more than decade high, barely changed from it. So all of these deflationary signals are globally synchronized. So bonds aren't really pricing the Swiss National Bank so much as they're pricing the fundamentals around the global economy that they believe the Swiss National Bank will have to react to, and do so predictably. That's the higher Swiss franc and lower Swiss consumer prices. So that's what lower bond yields have been pricing since last summer, picking up on the conditions worldwide, which would lead the Swiss National Bank to accelerate its rate cuts and eventually get to zero and go beyond it. These are all deflationary signals, however you choose to arrange them. And with these negative rates going more and more negative, that's the market saying it's more and more certain about these deflationary outcomes, like we just saw from the World Bank projections. The 2020s end up somehow being worse than the 2010s. And these negatives were echoed in the US CPI report for the month of May. Despite these expectations from Jay Powell on down that tariffs are going to be terribly inflationary, or tariffs are at risk of becoming terribly inflationary, there is zero evidence that's the case. And while that sounds like good news, it's actually not. It's consistent with everything we just went over in Switzerland as well as the World Bank. What the Bureau of Labor Statistics reported was that the CPI was basically unchanged in the month of May. It's up 0.08%. That followed a 0.22% increase in the month of April and a slightly negative rate back in March. So you do a little bit of math, that 3-month change in the CPI over these 3 months where tariffs have been implemented, that gives you an annual rate of just 1.01%. That's how little consumer price advances there have been. And all of that 1.01% over the last 3 months, just like the last several years, it's in the shelter imputation. When you take out the shelter imputation because it's fake, it has nothing to do with the economy today, it's not real, it's an accounting construction. When you get the all items less shelter index, that one was down fractionally in the month of May for the second time in 3 months. So down 0.015% in May, up around 16 basis points in April, but down almost 20 basis points in March. That's a 3-month change of minus 0.22% on an annual basis. Minus 0.22% outside of shelter prices for the entire rest of the CPI during a period when Jay Powell says inflation is going to accelerate, or we're worried about that inflation accelerating, and tariffs have been implemented, all of which means businesses that are seeing their costs rise are not able to pass those costs on the customer, which is consistent with the World Bank and Swiss rates becoming more and more negative. That points to a fragile, weak economy that's reaching, if not already at, its breaking point. In fact, the World Bank, in its downgrade, slashing its projections since January, they really say their numbers actually point to a world that's right on the edge of recession territory already. And remember, the World Bank, like all of these models, are always optimistic, which is why they always have to scramble to catch up to conditions by downgrading in these big chunks. Now, the Swiss bond market says the world economy may already be over the edge. And the Swiss bond markets say it's already over the edge. We've got more historically low rates on the horizon and even some negative rates that are back on the menu, including those in Switzerland that are already there. What they're saying, what the market is saying is that's our deflationary future. And it's not just a deflationary future, it's becoming such of a deflationary reality, even the models like the World Banks can see it too. The US CPI was supposed to be accelerating by now. Tariffs are already happening, but they aren't showing up, if only because these companies have learned they can't pass on these costs to their customers. But what that means is that these companies are taking a hit they aren't going to keep taking for very long. And if they do have to keep taking it, then comes the labor market payback, something that we're already seeing despite the mainstream reaction to the last payroll data. The last payroll data was pretty grim when you actually look at it honestly. So you have an economy that's struggling between a rock and a hard place, between costs that are rising and demand that is so weak and fragile, it falls apart with even the smallest price changes. And all of these things continue to point to an economy, a world in the 2020s that is somehow worse than the 2010s. Exactly what I've been telling you all along, exactly what the markets have been pricing for years. All of the pieces keep adding up, and sadly, this deflationary outcome, that's the bad news. It's not just the Switzerland bond market either. Steve and I talked about some stuff going on in the front of the Treasury curve that aligns with a lot of what we talked about here. Went over that stuff in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.